Business history is full of companies that reported record quarterly profits on paper, right up until the moment they filed for bankruptcy. This happens because of the mechanics of accrual accounting. Profit includes non-cash items, like depreciation or the recognition of revenue before the money actually arrives. In this diagram, the profit bucket fills with obligations and accounting adjustments, while the cash bucket remains static. Assessing whether an entity can actually pay its employees or settle its debts requires looking past these accounting treatments. An investor needs to know the timing, certainty, and scale of a company's ability to generate actual cash and cash equivalents. To provide this clarity, International Accounting Standard 7 mandates the Statement of Cash Flows. This standard requires every entity to categorize its cash movements into three distinct areas: operating, investing, and financing. By isolating historical cash movements from non-cash accounting entries, these statements allow users to develop models to compare the present value of future cash flows across different businesses. We begin with operating activities. This is the first lens through which we view a company's health, representing the core engine of the business. These are the principal revenue-producing activities, the transactions that generally enter into the determination of profit or loss. The engine works like this. Cash receipts from customers flow in, while cash payments for suppliers, employees, and income taxes flow out. If the net cash from these operations is negative over the long term, it indicates the company cannot maintain its operating capability or repay loans without looking for external funding. The second lens is investing activities. Here, the focus shifts from current operations to how the company is positioning itself for the future. This category records expenditures for resources intended to generate future income and cash flows. This includes the cash spent to acquire long-term assets, like property, plant, and equipment, or capitalized development costs. As these assets are placed on the timeline, they are expected to generate returns in the years ahead. Reviewing these figures tells an investor if a company is building its future capacity or if it is liquidating assets to cover short-term needs. The final lens is financing activities. This area shows us the external fuel, the capital, used to power the company. Financing tracks changes in the size and composition of the company's contributed equity and its borrowings. This includes proceeds from issuing shares or loans, and outflows to repay debts or pay dividends. When repaying a loan, the cash flow splits. Principal repayment remains a financing activity, while interest paid shifts to operating activities as it affects profit. This distinction helps users predict the future claims that providers of capital will have on the company's cash. To understand the full picture, we have to look at how these three lenses interact within a single period. In a healthy company, the operating meter shows a significant surplus, indicating the business generates enough cash to sustain itself. This surplus then funds the other areas, investing in new equipment for growth, and providing returns to investors or repaying debt. Because this framework focuses on actual cash, it eliminates the effects of using different accounting treatments for the same transactions, making it easier to compare different entities. By analyzing the borders between operating, investing, and financing, users gain a clear view of a company's financial structure, its liquidity, and its genuine ability to adapt to changing circumstances.